Hey, so I spent 12 years as an SBA lender, and I closed over 1,500 SBA loans during my time as executive director of an organization called Bankable. And now I'm kind of on the other side of the table. I own ProjectionHub, where we help small business owners and entrepreneurs get ready to apply for SBA financing by helping them craft financial projections and business plans and finding the right lender and just helping them through that maze of a process. And so one of the things that I really wanted to focus on in this video is how you determine whether your financial projections are reasonable and why this really matters in an SBA process. Now, a lot of times clients think, projections are just a guess. There's no right or wrong answer. And so it really doesn't matter what I put. I'll just put some numbers together and submit them to the lender. And I can tell you from experience as a lender that one of the things that often killed deals was unrealistic financial projections. So when we got a set of projections and it just seemed like, okay, this owner doesn't have any understanding of the industry or of what's possible here, or they send us projections and they're not profitable. They're not going to be able to cash flow the loan. They're not going to be able to repay the loan. Why did they send us these projections? So what I can tell you is that, maybe there's not a right answer. There's no way you're going to project perfectly what the future is going to look like, right? But I can tell you that there is a wrong answer. There are oftentimes you could submit a set of projections that are just not possible and will disqualify you for an SBA loan. And so I want to kind of talk through these three pillars here today of what we look for to make sure that the projections you submit to an SBA lender are going to at least not get you disqualified, okay? So there's three things that I look at. Are the financials in line with industry ratios? Okay, so we want to make sure that if you're in the restaurant industry and this is a simple Google search or check on ChatGPT, ask what are the typical industry profit margins or gross profit margins for a fast casual restaurant or a coffee shop or a bar. Talk to ChatGPT, describe what type of business you're doing, ask it for what are the typical industry ratios, and you can ask it for that by expenses too. What are the typical expenses or expenses as a percentage of revenue? Compare that to your projections. You want to make sure that, if food cost for a typical pizza shop is 25%, you don't want to submit a set of projections where your food cost is 5%. You're going to get laughed at, right? It's going to disqualify you. It's going to make you seem like you don't understand the business you're going into. And so this is really, really important. The next thing is you want to make sure that the projections cash flow, that you have sufficient cash flow. And you may have heard a lender, if you've been going through the process, the lender may say, hey, your projections don't cash flow, or this business doesn't cash flow. And so what exactly does that mean? Well, the simplest form, it could be that you send a set of projections and on the cash flow projection tab, you actually had negative cash. You ran out of cash. You ran out of money. This would be a really big mistake if you set a financial projections to the lender where you're actually projecting to be out of cash. You're projecting to not be able to repay the loan. You don't want to do that. So we see that from time to time just because the clients may not understand how the projections are all working and tying together. And so they end up actually sending something that almost disqualifies them by default. So that's the first thing you want to do. Make sure you don't run out of cash in your projections. The second thing you want to do is you want to make sure that you have a debt service coverage ratio of 1.25 or higher typically. So the typical SBA lender is going to want you to have a debt service coverage ratio of 1.25 or higher, which means that you have $1.25 of earnings or profit or cash flow for every dollar of debt service. So for every dollar of loan payments that you have, got $1.25 worth of profit to be able to pay that. That extra 25 cents gives you a little wiggle room, right? So to make sure you can make the payments. And that's what a lender is typically looking at. So if the lender says, hey, this doesn't cash flow, it could be that your debt service coverage ratio was 1-to-1. So if anything goes wrong at all, you can't make your loan payment. All right, so the last thing that you want to look at is whether your revenue and your kind of customer volume is reasonable. And this can really depend on the industry and the particular business that you're in. So for example, we'll see salons. A salon may have a set of projections and they think they're going to do $1 million in revenue. And what happens in loan committee, the lenders start looking at this, loan committee starts to look at this and they say, well, wait a second, how are they going to do $1 million in revenue? Because the salon only has 5 chairs and they're only open 10 hours a day. So 70 hours a week times 5 chairs. And the average purchase is going to be maybe $50 and it's going to take an hour to provide the service. And so they start doing this math and they realize that if you were at absolute full capacity, maybe your salon with the capacity you have could only do do 700,000 in revenue. And of course, you're not going to be at perfect or full capacity all the time, right? And so you can really get yourself in trouble or disqualified there by providing a set of projections that don't take into consideration your capacity. So that's one way to kind of rule yourself out. The other way I would say is a little more subjective. So your revenue projections could be too high. And how do you decide what's too high? The way I like to think about it is, let's say you're opening a coffee shop and you're able to get an estimate of the customer traffic at the Starbucks next door. So I like to use a tool. There's different foot traffic tools that can kind of estimate foot traffic at different retail locations. So if it's a retail type business, I like to use a tool called Placer.ai. They have a free version and it gives you some information with an estimate of like what's the foot traffic at this particular address. So for example, you could look up your nearest Starbucks and you might see, okay, they had 25,000 visits last month. Okay, so if you are opening your own coffee shop and you think you put in projections of 35,000 customer visits a month, outpacing like the top coffee brand in the world, then you're probably doing something wrong. Your revenue projections are probably too high. And so any data you can get on what competitors are doing and kind of the best in class. So again, if you can get an idea, you're opening a sandwich shop, an independent sandwich shop, and you can find out that the average Jimmy John's does, 1.3 million annual revenue, and you're projecting 2 million annual revenue. Again, here's kind of a flashing red light that says this probably is too aggressive. And so that again can get you ruled out or have the lenders think, no, I don't think you really understand your industry or what revenue should be for this type of business. So that's the way I like to think about how do I come up with reasonable projections. I'm not able to tell you exactly what the right projections are, but I can kind of narrow in on it. So that's why you see this triangle here. We're kind of narrowing in. So here's a guardrail. So it can't be outside of this. Here's another guardrail. It can't be over here. It can't be. So somewhere in this middle triangle, that's probably what our correct projection should be. That's what you want to do. You're trying to come up with what could be reasonable for my specific situation. And that's what you want to make sure that you're displaying to those lenders, because they're going to be doing this kind of work in their head. They've seen a lot of businesses. And so when they look at a set of projections that seem really outside of the norm for what they expect, their alarm bells start ringing. Okay. And so I want to help you make sure your projections are reasonable before you submit to the SBA. If you need any help creating your projections or even just want a review before submitting to your SBA lender, please feel free to reach out to us at support@ProjectionHub.com. We help clients all the time create their own set of projections. We have a number of templates that are available on our website as well, ProjectionHub.com. You can take a look at those. There'll be a link in the description of the video below to be able to grab a template or reach out to us for help crafting your projections. All right, we hope that's been helpful. If you think this has been useful for you, I'd love it if you like and subscribe. We are trying to produce more SBA content to help clients as they're looking for SBA loans. And so if you think this has been helpful, it would really, really help me if you would like the video and subscribe to our channel. Thanks.